Hello everyone, and welcome back. Today we are going to tackle a beast. It is a topic that divides dinner parties, dominates the headlines, and confuses the absolute heck out of new investors. I'm talking, of course, about negative gearing. If you have ever been to a backyard barbecue in Australia or attended a property seminar, you have heard this term thrown around. It's almost a rite of passage. But here's the reality. Despite how often we say the words, a massive number of investors are still scratching their heads, wondering how it actually works under the hood. Is it a tax loophole? Is it a magic wand for wealth? Or is it a dangerous trap? Today, we aren't just going to define it. We're going to demystify it completely. Whether you are a seasoned pro, trying to optimize your tax position, or a complete rookie, just dipping your toes into real estate, understanding this strategy is absolutely crucial for your financial future. Let's dive deep. Part 1. What on earth is negative gearing? Let's start with the basics. Strip away the jargon, the politics, and the noise. At its core, it is surprisingly straightforward. Imagine you start a small business selling lemonade. To sell that lemonade, you need to buy lemons, sugar, cups, and pay for a stand. If the money you spend on those supplies is higher than the money you make selling the lemonade, your business is running a loss. Negative gearing is exactly the same concept. You are treating your investment property like a business. When the cost of owning and maintaining that property is higher than the rental income it generates, you are negatively geared. To put it simply, you're losing money on a monthly or annual basis. Now, I know what you're thinking. Wait a minute. Why would I sign up to lose money? That sounds like a terrible business plan. And usually, you'd be right. But here is the twist. In the world of property investment, think of this as running a business at a loss, except this specific loss can actually work in your favor when tax time rolls around. Let me walk you through how this works in practice, because the numbers tell the story better than I can. Let's say you go out and purchase a solid investment property. You have a mortgage, you have a property manager, and you have maintenance costs. Let's assume your total annual expenses, mortgage interest, insurance, straight-up fees, the works, come to a total of $30,000 for the year. However, the rental market is what it is. You have tenants in there, but your total rental income for that same year is only $25,000. Do the math. You are running at a $5,000 loss. In a normal scenario, that $5,000 is just gone. But this is where the negative gearing tax strategy comes into play. The Australian tax system allows you to take that $5,000 loss and use it to offset your other taxable income. This is the mechanism that potentially reduces your overall tax burden. It transforms a cash flow loss into a tax-saving vehicle. Part 2. The magic of tax implications. This brings us to the magic of the strategy. And I use that word carefully because it's not magic, it's math. But the effect can feel magical when you see your tax return. The real power of this strategy is unlocked when you fully grasp the tax implications. Here is the golden rule. Every single dollar you lose on your investment property on paper can be deducted from your taxable salary or wages. This means the actual out-of-pocket cost to you, what you feel in your bank account, is less than what it looks like on the spreadsheet. Let's break this down with a concrete example, because I want you to visualize this. Imagine you are a professional earning $100,000 per year. That is your gross income. Now, you have that investment property we talked about, and it is negatively geared with a $10,000 annual loss. When you file your taxes, you don't pay tax on the $100,000. You subtract that $10,000 property loss from your salary. So the tax office views your taxable income as $90,000. You're paying tax on a smaller amount of money. This is why you often hear that this strategy is favored by high-income earners. The mechanics of our progressive tax system mean that the higher your income tax bracket, the more attractive this negative gearing strategy becomes. If you're in the top tax bracket, the government is essentially handing you back 45 to 47 cents for every dollar you lose on the property. It is essentially the government subsidizing part of your investment property costs. They are helping you hold the asset. But, and this is a huge but, why are you doing this? Are you doing it just to pay less tax? No, that is a trap. You are doing this because you are waiting for capital growth to deliver the real returns. Part 3. The strategic philosophy. I want to pause here and look at the philosophy behind this. I cannot stress this enough. The goal of the negative gearing tax strategy is not to lose money indefinitely. If you're losing money every year for 30 years and the property price never goes up, you haven't invested. You've just engaged in a very expensive hobby. Smart investors use negative gearing as a stepping stone. They accept these short-term losses, these monthly contributions to the mortgage, as the price of entry for long-term capital gains. You are playing the long game. The life cycle of a successful property usually looks like this. Phase 1. You buy the property. It costs money to hold. It is negatively geared. You use the tax benefits to help manage that cash flow. Phase 2. Time passes. Rents go up due to inflation and demand. Your mortgage hopefully stays relatively steady or you pay down the principal. Phase 3. Eventually, the rental income overtakes the expenses. As your property value increases and rental income grows over time, many negatively geared properties eventually become positively geared. That is the holy grail. At that point, the property is providing you with both passive income and capital growth. Negative gearing is just the bridge you build to get to that destination. Part 4. Who is this strategy for? Now, let's get personal. Is this right for you? I see a lot of people trying to copy-paste strategies they heard on a podcast without looking at their own bank balance. This specific negative gearing strategy is not a one-size-fits-all approach. Understanding when to use it and how to use it is the difference between building massive wealth and creating incredible financial stress. You have to align this strategy with your personal financial situation and your long-term goals. So, who is the ideal candidate? For the right investor, this could be a powerful wealth-building tool. Generally speaking, it works particularly well for those with stable, high incomes. Why? Because you need to comfortably cover the shortfall between the rental income and the property expenses. Remember, the taxman only gives you money back once a year, but the bank wants the mortgage paid every month. You need the cash flow to survive the months in between. We often see this strategy aligning perfectly with young professionals climbing the corporate ladder, established business owners with consistent cash flow, dual-income households where one salary can cover living expenses while the other services the investment debt. If you're living paycheck to paycheck, negative gearing is dangerous. If you lose your job, you still have to fund the property's loss. But if you have capacity, it's a way to accelerate your asset base. Part 5. Location strategy. Let's pivot to the fun part, the property. You can have the best tax accountant in the world, but if you buy a lemon, you're in trouble. As we mentioned, this strategy relies on capital growth. Therefore, the negative gearing tax strategy shines brightest in growth markets. You need to find areas where capital appreciation is expected to outweigh those short-term losses we talked about. If you're losing $5,000 a year on cash flow, but the property goes up by $20,000 in value, you are winning. If you lose $5,000 a year and the property value stays flat, you are just burning cash. So what do you look for? You want cities or suburbs experiencing population growth. More people need more houses. Infrastructure development, new train lines, hospitals, schools. Economic expansion, jobs bring tenants and buyers. These are the ideal conditions for this approach to succeed. I always tell people, property selection is where many investors make or break their negative gearing strategy. You have to look for properties with strong fundamentals, limited supply, and diverse employment opportunities. These are the factors that drive rental demand, keeping your vacancies low and capital growth, making the whole exercise worth it. Part 6. The risks, the dark side. I would not be doing my job if I didn't try to scare you a little bit right now. We need to talk about the risks. While the tax benefits are attractive, you must understand the full financial picture before diving in. This strategy requires a realistic assessment of your financial resilience. Risk 1. Cash flow. This is the most obvious consideration. Even with tax benefits, you are still out of pocket. You are bleeding cash each month. Ask yourself honestly, can your budget comfortably absorb this shortfall? Does it impact your lifestyle? If your car breaks down, or you want to go on a holiday, is the property sucking up all your liquidity? You must not let it affect your emergency savings. Risk 2. the variables. The economy changes. You need to factor in potential interest rate rises. If your mortgage rate doubles, your loss widens significantly. Can you handle that? You also need to factor in periods of vacancy. If the property sits empty for 4 weeks, that is 100% loss with zero income. And let's not forget unexpected maintenance costs. Hot water systems always seem to burst on a Sunday night when plumbers charge double. Many successful investors I know maintain a buffer, a sleep well at night fund. They keep at least 3 to 6 months of property expenses in cash to weather any storms. If you don't have that buffer, you are walking a tightrope. Risk 3, market risk. This is critical. Negative gearing amplifies both gains and losses. If property values decline or remain stagnant, you could find yourself paying out of pocket for an asset that isn't growing in value. That is a financial disaster. This is why thorough research and choosing properties in fundamentally strong markets is non-negotiable. You cannot just throw a dart at a map and hope for the best. Part 7. How to make it work for you. So, we know what it is, we know who it's for, and we know the risks. How do you execute this? Success with a negative gearing tax strategy isn't about luck. It is about strategy, patience, and making informed decisions. The investors who benefit most are those who approach it as part of a broader wealth-building plan, rather than a get-rich-quick scheme. Here is your checklist to get started. Step 1. Get your house in order. Before you even look at a real estate listing, look at your own finances. Ensure you have stable income. Manage your personal debt. Get rid of those credit cards. Ensure you have adequate insurance. Income protection is huge here, and build that emergency fund. Step 2. Build your team. You cannot do this alone. Work with a qualified accountant who understands property investment. Do not just get a tax filer, get a strategist. Ask them to model different scenarios for you. Ask them, if interest rates go up 2%, what does my cash flow look like? How exactly will this impact my tax position? Knowing these numbers in advance removes the fear. Step 3. Hunt for fundamentals. We touched on this, but look for those drivers of growth. Growing populations, improving infrastructure, and limited supply. Conclusion. As we wrap up today's episode, I want to leave you with a clear perspective. The negative gearing tax strategy remains one of Australia's most powerful wealth-building strategies, but only for investors who understand how to use it effectively. It is not about losing money. I will say that again. It is not about losing money. It is about strategically accepting short-term losses while building long-term wealth through capital growth and tax efficiency. It's a trade-off. You sacrifice some cash flow now for a bigger asset base later. The key to success lies in careful planning, choosing the right properties in growth markets, and ensuring your personal financial situation can comfortably support the strategy. When done right, this strategy can accelerate your journey to financial independence. It helps you build a valuable property portfolio while the tax benefits act as a buffer, helping you manage the carrying costs. Whether you're considering your very first investment property or you're looking to expand an existing portfolio, understanding negative gearing gives you another tool in your investment toolkit. So, here's my challenge to you for this week. Don't just listen to this and nod along. Take the time to speak with qualified professionals. Crunch the numbers for your specific situation. Don't rely on what your mate said at the barbecue. Make informed decisions that align with your long-term financial goals. Property investment is a marathon, not a sprint. And negative gearing? It's just a pair of really good running shoes. It helps you run, but you still have to do the work. Thank you for listening, and see you next time.